everyone. I'm Rita Garwood, editor-in-chief of ABF Journal. Joining me on the podcast today is Mitch Soiefer. Mitch is partner and head of lender finance at SLR Capital Partners. Mitch, thanks for being on the podcast today.
Absolutely. Thanks for having me on today. Excited for it.
Awesome. Can you just tell us a little bit about yourself and what you do for SLR?
Absolutely. So I've been with SLR for almost 17 years now. I'm a partner of the firm and I run the lender finance business. It's the business of financing other finance companies. SLR is a multi-strategy credit manager, and we have four primary verticals: asset-based lending, lender finance, healthcare, life science, and cash flow lending. And I run the lender finance vertical.
Great. So we're approaching the end of the year. How would you describe the state of private credit today, as the year is ending and we're heading into 2026? What's changed most meaningfully in the last 12 months?
Yeah, absolutely. So, it's certainly been a lot of transformation over the last 12 months and the years beyond that. I would say the thing that's probably most relevant is over the last 12 to 24 months, there's been significant capital formation into the private credit asset class. And a lot of that capital has really been on the upper mid market, broadly syndicated loan uh, segment of the market. So what we've seen is that market in particular on the cash flow side has become quite tight from a pricing perspective, compounded by the fact that M&A volume in 2025 has been a little bit less than some of our prior years. So you put those two together, and there's a lot of capital chasing fewer transactions on the cash flow side in the upper mid market or upper market. And so what we've been seeing is more opportunities in specialty finance verticals, things like asset-based lending and lender finance and life science verticals, where there hasn't been quite the same capital formation.
Hmm. So there have been tighter credit conditions, and that's been creating a more selective market. Where are you seeing opportunities open up for disciplined lenders, and where are you seeing pullbacks?
Yeah, so what we've been finding is there's more opportunity in areas that maybe are just a little less saturated, where there might even be a complexity for premium. And that complexity could be just it takes a lot of operational management to look at certain transactions, or a lot of due diligence or specialized sector focus. So on the cash flow side, that means maybe more in healthcare. But then in areas like asset-based lending and factoring, well, there's a lot of labor that goes into doing those transactions. You need a lot of people doing verification work, analysis. So we see more opportunities in that asset class. Same thing in life science lending, where you need a particular expertise, and in lender finance. And so in those categories, we've been expanding in 2025, and we think that hopefully should continue into 2026. And that's where we've been finding opportunities.
So, specialization and sector depth have been becoming bigger differentiators for a little while now. Which areas demand the most expertise today, and how is SLR investing in specializations?
Yeah, so I completely agree with that sentiment. So SLR across our platform has north of 300 people, which is a lot of people for the amount of capital that we manage. And the reason we have such a broad employee base is the asset-based lending vertical, where over half of our employees sit. And so we've been investing heavily over the last decade in expanding those verticals that I mentioned, because we think that having a lot of people focused in those categories is really, really critical. And then I think on the cash flow side, where we do a lot in healthcare, we've been investing in healthcare for years and have a team dedicated to it. We have a healthcare asset-based lender who's really, really good in this space. And so I agree with your sentiment, and that's the areas that we've been investing in. We continue to expand all of the teams across the platform. I think in the last couple of years, we've really accelerated the hiring. But importantly, specialization takes years, and we've been in each of these asset classes for north of a dozen years. And so we've got a lot of expertise and a track record that goes along with it.
That's great. So the economic environment lately, the economic growth has slowed and rates have been elevated for a little while. They've been starting to come down. How are borrowers behaving differently today? And what signals are you watching most closely as you underwrite new deals?
Yeah, so absolutely. And so you're right about the higher interest rates. And, clearly while rates are coming down a little bit and that's providing some relief, that has an ability to reduce cash flow for a lot of these businesses just because there's more interest expense. So what we've been watching is interest coverage, making sure our businesses have liquidity to make sure that they are set up for success over the course of the next couple of years. Importantly, all of our transactions are highly structured deals with covenants, and that gets us to the table in the event any company is having some sort of issue well before there might be any risk of impairment. So, we are watching everything very closely. We sort of always invest as if we're late in an economic cycle. That's sort of our DNA. And, we think that that's a good philosophy right now because, who knows what the future will bring. But we always want to make sure we're going to be protected if there is economic softness.
Okay. So in this environment, portfolio management has become a lot more hands-on. How is SLR approaching monitoring engagement and problem solving across your borrower base?
Yeah, so this is when I was talking about the complexity premium, it's also this, which is monitoring the portfolio is really critical. And I'd give you a couple different examples. So in lender finance, for instance, we finance businesses that are also themselves commercial finance companies. They have portfolios day one, the day we underwrite the transaction. But over time, that portfolio will shift and they will do new transactions, get paid back on transactions. And so important for us is making sure that we're keeping a close eye on the portfolios as they evolve over time. So we have teams that are dedicated to doing that analysis. We often engage third-party field examiners to do checks on an ongoing basis, and that crosses to our asset-based lending strategy as well. And so that's really, really critical. In asset-based lending, the work can be on a weekly, daily, or monthly basis, depending on the borrower, where we're constantly vetting the borrowing bases that we have. We're looking at receivables, making sure there's verification work going on, making sure there's cash reconciliation happening. And so there's a lot of work that goes into it. And that's where, again, a lot of the people at SLR are focused.
So we talked earlier about interest rates. Because of that, middle market sponsors and borrowers have been facing a higher cost of capital than they did a few years ago. How is that affecting deal structures, leverage, and covenants?
Yeah, so I mean, definitely, it is reducing the amount of leverage that companies are comfortable with because companies and borrowers will always be looking at, what is my debt coverage ratio and how much free cash flow am I going to be generating with the capital structure I have set up. So, we're clearly seeing, companies wanting to make sure that they are set up with capital structures that they can maintain. And so, we'll see a little bit of that, but I think also rates are coming back down. And so, we'll see how things play out over the next couple of years.
So private credit has been gaining share in the financial ecosystem for a while now. What do you expect? Do you expect that growth to continue in 2026, or do you think it's going to slow down?
So I do believe, especially in the specialty finance verticals, you're going to see a continued movement of assets away from banks and towards private credit lenders for a couple of reasons. When you think about asset-based lender finance and even life science to some degree, these are companies that are typically unrated. They typically do not come with large deposit bases that banks might be interested in. And so, it makes sense that private credit can pick up some of the slack on businesses like that. I think that these companies may have receivables that are investment grade quality when you look through ultimately to what our collateral is, but from a pure company perspective, they may not be investment grade themselves. We're able to do that look through, and that's what we tend to specialize in. I think that in addition, just there continues to be movements from banks following 2023 Signature, Silicon Valley Bank, et cetera, of assets moving towards direct lenders, and I think that trend will continue.
So let's look ahead to 2026 for a minute. What themes do you think will matter most for lenders who want to outperform rather than just kind of participate?
Yeah, so I think that having the multi-strategy approach for us is what we think is really critical because what it allows us to do is pick the spots in a given year where the market is more opportune. So in 2023, for instance, even though we have the multi-strategy, particular focus on specialty finance, 2023, we did a tremendous amount in cash flow lending because that market was very dislocated and we were seeing really good risk-adjusted returns. As we look at 2025 and into 2026, it's the specialty finance verticals that we think are probably going to have the better opportunity set. but markets change very, very quickly. And we always want to make sure we're able to adapt to those changes. So I would say, as I sit here today, we think it'll be more specialty finance, but we always want to make sure in the event any of the markets dislocate, we're ready to capture that and be a liquidity provider into the market.
So, what do you think borrowers, sponsors, and co-lenders should understand about SLR's approach as we enter this more disciplined phase of the cycle?
Yeah, so I think importantly for us, we try to stick to our knitting. We try to do what we've been doing for the last close to 20 years as a platform and be consistent about it. We try not to stretch in years where the markets get tight. That's what the multi-strategy approach gives us the opportunity to do. And we want to make sure we're always doing our due diligence up front and on an ongoing basis. And so I think maintaining that discipline is really, really critical. And it's something that we have been very focused on and will continue to be focused on as we look out into the next couple of years and beyond that. I think that, we're always trying to find, good people. And so, we are consistently adding to all of our teams. And I think we'll probably look to do more of that as well, as we think that there's a really good opportunity set right now. And again, I think, more of the same. So hopefully continuing to expand into specialty finance.
That's great. Well, Mitch, thank you so much for joining me today and for talking through all of these topics. I appreciate you taking the time.
Yeah, absolutely. Thanks. I appreciate it. I do read the journal, so I'm excited to be part of it. Thanks very much.
Awesome. Thanks so much.